Hello and welcome to BQ Prime. You're watching Earnings with BQ, and my guest today is Mr. PB Balaji, CFO of Tata Motors. Balaji, thank you very much for joining us on BQ Prime. Let me start off with this capital reduction program that you have. You are swapping your DVRs for ordinary shares. But one question that comes to mind is that, the tax implication, because that's something which the street is talking about, and they want to get some more understanding on what kind of tax implication will it be there on domestic residents or FPIs or mutual funds or others. And in that concept, there is a deemed dividend concept which is coming in. Can you explain to us what could be the deemed dividend on which you're going to, withhold tax at the rate of 10% for domestic resident?
Thanks, Ajay. Thanks for having me on the show. Yes, it is the tax side of it is something that we have explained even in our investor deck, and do invite shareholders to take a look at that. Basically, there are three components of this tax. One is since it is a capital reduction, to the extent of accumulated profits that are there on the effective date of the scheme after the NCLT is approved, that's about 12-15 months from now. Whatever is the profits that have been accumulated in the balance sheet at that point in time will be treated as a dividend that has been paid out to the DVR shareholders, and therefore that will be withheld, and that's section 222D income tax, and therefore that is something that is a first tax impact that will be there. The exact number of what will be that number, we will not be in any position to say, because that is what is going to be the accumulated profits 15 months from now, assuming the scheme is coming into effect 15 months from now. On that balance sheet date, whatever the accumulated profit will get paid out as a dividend. And obviously, since it's a withholding tax, you'll also get a tax certificate for that. Second aspect of that is what is the capital gains, because people would have bought this share at various points in time, and they will have their own cost base that they would have. And whatever is the Tata Motors share price at that point in time, into 0.7 is the what we call as a consideration ratio that we are paying for this. That versus remove the deemed dividend portion less the cost, that delta then becomes the capital gains, which each of us, depending on what tax bracket we fall under, is something that we will pay a capital gains on that. There's a third smaller aspect of it, because obviously the trust that is being set up to receive the shares and then sell the shares, the trust at that point, and by the time assuming, let's say I give the shares today and the trust sells off maybe 5 days from when I gave the shares to the trust, in that 5 days, there could be a small gain or loss that could happen. That could be a short-term capital gains or a short-term capital loss that could happen. And they'll also pay a small STT on the transaction that they will do. That is the third aspect of it. As far as the shareholders are concerned, this shouldn't make a difference, because anyway, all these are withholding taxes which they can claim back in their tax return. And also, once the capital gains has been paid, your cost base gets reset on that particular date. Therefore, you get back almost everything. It is just the law of the land that we have to comply with, and hence this process has been put in place. And in any case, all of this will be executed by the trust, which means I give the shares to them. At that point, basically, the ordinary shareholders will first approve that we will set up a trust. And once they say we authorize the trust to receive the shares on our behalf, the shares will be received there. The shares will then sell as many shares as is needed to take care of all these taxes, and then remit out the remaining whatever small cash that will be left behind. And of course, the remaining ordinary shares will also be remitted to the shareholders. So therefore, from a shareholder's point of view, all this will be taken care by the trust, and they'll get the net amount in their hands, along with the relevant certificates that is needed for filing their tax returns. Hope that clarifies.
So just a clarification on the accumulated profit. So it could be whatever is there on your balance sheet at the end of that financial year, or closer to that
on the effective date. On the
effective day, or whatever it is there. So it's retained earnings minus accumulated losses and others. You calculate that, and based on that accumulated profit, you will look at, and then you divide that per shareholder, and whatever is accrues.
That is basically assumed as being distributed to all the A ordinary holders only, not ordinary holders, all the A ordinary.
So the burden of the whole entire what do you call withholding tax comes only to the DVR holders, not to others, right?
Not to the not to the ordinary holders, because it's a capital reduction of the A ordinary holders, and therefore it's treated as equivalent to a liquidation of a company and then paying out all the accumulated profits on that day to that people for whom the capital has been reduced. And as far as the ordinary holders are concerned, them there's no transaction happening at their end.
But they get benefited anyways because their earnings per share increases.
Oh yeah, total number. See, there are 50 crore DVR holders, and therefore for every 10 DVR holders, we are giving 8 ordinary shares, and therefore there are 35 crores or new ordinary shares that will be given. So that is a 15 crore reduction in the total number of outstanding shares in the company, and that's equal to roughly about 4%. So on a EPS basis, everybody benefits by the EPS going up by 4%, which automatically increases the value of the company. Number one. Other thing that they also benefit in is the overall liquidity for the ordinary holders also. Suddenly 35 crore more ordinary shares are coming into the market. But it's all it is going into the minority. The promoters are not to that extent. Promoters' voting rates are actually going down here. That 18% increase in liquidity will also benefit the ordinary holders. Number two. Number three, overall market capitalization of Tata Motors has been reduced to the extent of the discounts that the A ordinary was having in the market. With this gone, you will also see a spike up in the overall market cap of the company. So later on, if supposing for argument's sake, some capital raise is needed for some M&A or something later on in life, then you have this discount doesn't suppress the price to that extent. So that's how the piece is.
Yeah, okay. With that aside, let's come to the performance of Q1. JLR, excellent performance coming in well ahead of street. You've been guiding at more than 6% of margins for JLR. And you came at 8.6% and on an adjusted level 7.5. Are you confident to maintain about 6% or 7%, 7.5%, which you did in Q1 for the rest of the year?
So we're pretty confident about the performance of JLR and CV PB, all of them in that respect, for three reasons. If I take this JLR business, with the mix being where it is, order book being at 185,000 units, and break-evens continuing to remain low, we would expect the performance to continue to be strong. We do have a temporary blip which will happen in Q2 in terms of the sequential improvement because of it's just summer holidays, so it's phasing issue or a typical noise that happens in any setup. But on a full year basis, we are quite confident of the guidance we have put out there. And we also believe we need to take a look at it in Q2. We consciously said, let's not jump into it in just one quarter. Let's see a half-year performance, then we'll be in a better position. And assuming the results are in October, November, a lot of the year would have passed. And therefore, when we say something at that time, the ability to also forecast will be much better at that time. So we said,
quarter. So will you be going for a guidance upgrade when you come with the number?
Let us see. We haven't. We'll say we'll review this in Q2. That's all we said.
Okay. The other thing is about the dividend policy for JLR. It seems that you are inclined to getting dividend from JLR going forward. What kind of policy are you setting it up for?
See, the dividend policy there is 25 to 40% of PAT is the policy that's in the public domain, and the board will consider it at that point in time to see what is the appropriate level of dividend that need to come up. But the policy is 25 to 40%.
And you expect this time a good payout coming out from JLR into TAMO?
Naturally, given the performance, we would expect to see them end on a strong wicket, in which case the dividend is very much a fair expectation. But
I asked this because there is a pretty aggressive capex which is coming from JLR as well going forward, right? So that's the reason I'm asking that, will there be a dividend payout actually happening because they have a capex requirement and it's have to be funded internally for them as well.
See, our guidance for the year is to reduce the debt to below $1 billion. And we started at about 3.5 billion last year. So therefore, we were looking at almost 2 billion of cash flow coming through after capex, after interest payments. So capex is not in question at all. We will incur the 3 billion pounds of capex. And over a 5-year period, we have guided for a 15 billion of capex. That's all well funded within their own funds. And therefore, when you're talking about dividends, it's on top of it and not at the cost of capex, which we will never allow.
And the entire 2 billion of cash flows will be from operations and JLR, right? or is it going to be sale of non-core assets as well, which you've been
No.
talking about?
See, when I'm looking at this, as far as JLR is concerned, the reduction that we are talking about is only free cash flows coming out of operating cash flows, less capex, less interest, less any tax payments. Yeah. Domestic CV PV will also, as far as CV is concerned, it will be cash positive as it has been, and PV will also be cash positive. The only place where we will be having investment greater than the operating cash flows will be EVs, for which the TPG monies are well funded for that. We are well funded for that number. And then on top of it, as you're well aware, the Tata Technologies DRXP has been approved and by SEBI. Therefore, we are responding to whatever minor points that are there. And after that, there is one more one. We will, during the course of this year, when market conditions are appropriate, we will take a look at that in terms of going to market on that IPO.
So that will come in by end of the calendar year or fiscal?
We will see how market conditions play out. If everything goes well, we would want to execute this year, in which case that will also be a part of the debt reduction plan for the year. But we have said by FY25 when we go fully net cash, we have postponed it by 1 year because of the JLR semiconductor issue that was there. So we should be able to complete this in that time period.
Balaji, one of the significant development that took place is the kind of investment that Tata Sons is making in UK on batteries and storage, and you being the anchor customer for them. Give me a perspective of how it's going to help you in your operations.
I think it's a very interesting proposition for any OEM when you have a parent which is this supportive, and between the parent and us, we are able to then manage the demand and supply of the entire ecosystem around EVs. And I think as Tata Motors Group, we are uniquely placed amongst any OEM in the world in terms of having a say in cell manufacturing, charging infrastructure, technology, software, and of course the auto OEM as well, auto component manufacturer, all of which are coming to play together, and that makes us unique. And also there are significant advantages of this because from a Agritas, which is the Sons entity that is investing in cell, does not have a demand risk because we are the anchor customer lifting a majority of their volumes. And as OEM, we don't have a supply risk because we are the anchor customer with 70% of the volumes coming from Agritas. At the same time, it's not 100% because that also gives us play to plug into the whichever is the evolving technologies that are there. And then, of course, given that this is all operating on the same parent, our ability to actually, the trust and the synergy that is available to speak to each other, to look at technology evolution, and have the virtuous circle going between the battery manufacturer, battery pack manufacturer, OEM, and back. That loop is something which is going to be synergistic. And that virtuous circle, when it kicks in, I think we still don't fully fathom the spin-off benefits that we will get in both designing of cells, designing of the cars, and designing of the battery packs, and of course the charging infra needed for that. So we moving together is actually reducing risk substantially for all players, and we are yet to actually foresee the spin-off benefits that will come when we start thinking together and we do joint business planning together, decide which technologies to invest in, decide which manufacturing processes to adopt, what are the form factors that we adopt, all of which is now available to move at speed because we work together as one group. So, which is, I believe, together winning big is how we would want to position this whole space.
So the Tata Motors domestic arm will also be sourcing or importing batteries from this.
We already signed the Tata Motors domestic business. The Agritas has already signed an MOU with the Gujarat government for setting up a battery plant here in India, 20 gigawatt hour. And therefore that is 40. So between the two, there's 60 gigawatt hour being set up. And therefore the domestic business will source from the Gujarat plant that will be set up, while the JLR business sources it from there. Flip side, Agritas will also be selling to other customers in India as well as in UK, not just for auto, but also for storage and other purposes as well. So intention is to make it as a commercially viable arm's length business.
Since we are talking about EV, how's the EV balance sheet or P&L looking like? There is, the street wants to understand, what kind of margins EVs on a standalone basis can work on. And now that, that separation has happened, asset-light model which you created, Can you give us a sense of EV margins play versus ICE margin play?
We have put that out in the pack as well, just to ensure that people get a hang of how the performance is of this business, and we will give more information as we go along. And currently, the profitability on it at an EBITDA level of the PV business is running at about 8.6%, and EV was negative this quarter at 9.6 negative. And but that I'm not particularly worried about because two factors contributed to it. One, IPL was front-ended, and that's almost 200 bps of delta margin because we invested upfront in IPL. And second is the lithium battery prices have gone up quite a bit in the last 1 year, and that has now started turning, and we are starting to secure the benefits of that. And third is PLI. When PLI comes through, that will also be a 13 to 18% kind of margin that will come onto the PNL as well. So all put together, we are quite confident that this business will be profitable as well as cash accretive, and no major concern. Right now, it is investment time. Now, right now, it is to ensure that we have the products out there, and we are clocking at about 20,000 cars a quarter. And with new cars coming, I think the year will be more like 100,000 cars of EVs will sell, which is given all the competitive intensity, we are continuing to step up our momentum on this game, and hence quite happy with our performance on the EV side. Intention is to step this up further.
Is there a timeline for profitability at the operating level for you?
At an operating level, the EBITDA, see, if you look at last year, FY23, when we ended, we lost about 300 crores. And the 300 crores is almost entirely product development costs that have been charged out. So we are already at a break-even level in that business. And we'll be break-even this year also, as far as adjusting for product development costs, because product development costs that you're putting in is for future growth. So not worried about that. So you can say mentally that this business will be self-sufficient pretty soon.
And the capital will be self-sufficient because the
Capital,
investors
we
are
are
already
funded for that. Yeah, we are funded for that. So once we consume that capital, this business by the time will be able to stand on its 2 feet.
There is also the PV performance has been good. How do you see PV playing out? Because especially within the passenger vehicles segment, SUVs are playing a big role, and nearly half of the market is now SUVs. So and you've been aggressive in that area. So how do you see your market share moving in that segment?
See, I think for the current year, it is the first 2 quarters. I mean, the last 2 quarters is the one where we had the toughest challenge because we didn't have many cars coming. We had new powertrains coming in. Tiago had an EV powertrain, and Altroz just about got a CNG powertrain. Those are the only 2 cars that we had. But starting now, the new launches start happening. We have the refreshes starting to come through. So in this 2 period, we had picked up market shares to 14.2%. That gives us quite confidence. I think the second half, it should be a pretty good run as far as continuing the competitive performance there. And at the same time, we are clear that the focus will have to remain on product offensive. Right products in the right segments with the right powertrains. It is not just launching cars. We've been saying that again and again, that it is as much a powertrain game as it is a car in the right segment. And we are seeing Tiago coming back strong, Altroz coming back strong, Tigor coming back strong. All these are cars that were launched a fair time back and still doing well. And therefore, as long as you are being relevant to the consumers' challenges and we're providing right solutions, I think growth is there to be taken. And that's how we'd want to play this.
One of the concerns which is coming up is primarily on the CV side, where you have been losing market share for the last couple of months. Your market share has fallen from 54% in FY22 to 50%, and in Q1 is to 47%. What is the company doing to stem that fall? I'm told that the products are the reason why it has fallen, but what kind of product development or new products coming in this segment?
See, it's not about the products have a problem, just that the availability of the products at the right time was an issue because the BS6 phase 2 migration, we took it at a much larger canvas, as Girish puts it, a bumper to bumper change. Hence, we're giving the right value for them. That meant some of the execution was not as flawless as we would have liked it to be. But that's life. We'll have to just take it on our chin and move on. At the same time, we also are conscious that the focus will have to be on Vahan market share. And to win Vahan market share, you will need to focus on the brand, on the innovation, on the customer service. And which is the reason on which we've done the organization changes to merge sales and service together. of trucks separate and small commercial vehicles separate, because these two different business models. And so we have taken all the steps to actually put the right focus there. And just like every other problem that we've been dealing with, when you want to open a price issue up and then resolve it, we want to resolve it forever. And therefore, the CV business is saying we believe it should be positioned on value, should be positioned on solving the customer's challenges rather than just a mind-numbing chase for wholesale market shares. That's not the way we run this business. And therefore, those pivots have already been done, and we're seeing good returns coming through with the changes that we have put in place. And therefore, quite confident that now onwards, this business should start delivering.
Are you seeing good demand coming for CVs? And because within the CV, the MHCV is seeing good demand as per industry, but we are seeing sluggish demand coming for LCVs. So are you seeing the same trend? And what about the discounting? Have you reduced the discounting as other players have done in the market?
So I think demand from a heavy commercial segment, cargo, I think that is quite strong, as you rightly put it. Similarly, the tipper segment, the construct segment continues to do well because the infrastructure investments that are happening there. Some amount of sluggishness in e-commerce we did witness, but I think that is subsequently now starting to ease out as well. And therefore, we believe going forward, this business should, the demand in the industry should come through quietly without any major challenge per se. And we had challenges of fuel price increase, interest rate increases, all that, price increases of steel. I think all of those have quietened down. So therefore, I think we are in a bit of a clearer waters and calmer waters as far as CV is concerned. So hopefully that should help everybody to reorient themselves and win correctly. And as far as market discounting in the market is concerned, we are convinced that this business has to be providing solutions to customer. And as long as you're providing the right solution, it's an extremely savvy industry. The customers are very savvy. They understand what exactly they want, and our job is to serve that needs correctly. Then you don't have to worry about your margins or your share. If we don't do that right, then we will struggle with that. So that's what we want to solve for, and we believe we are on the right track on doing so.
Does that change with the new norms coming in with respect to ACs for commercial vehicles? Will it require further development of products for you as well?
No, I think putting in the AC, I think it's a good, as Tata Motors, we made it clear that it's something that we welcome and it's good for the drivers. I think the most challenging in this entire value chain of CV, the role that is most challenging is the one of the driver. And as long as we are taking care of the driver, it's good for everybody in the setup. So we welcome that. And from our perspective, we'll do everything that we can to implement those, and of course at the most optimal costs, so that we don't burden the fleet operators.
Are you looking at electrification of some of the commercial vehicles, like some of the competitors are also working on?
Absolutely. I think the last mile is something that we've already electrified. We started selling at about 300 odd aces we already sold. And with the FAME certificates now received, you should see that step up. Similarly, bus electrification, we're also seeing good progress happening. That will continue. And I think now the intermediate segment, I think some of the options on last mile electrification is also underway. And at an appropriate time, we'll announce those plans.
I'm talking from an MHCV point of view, mining trucks and those kind of
I
stuff.
think limited use, definitely there are use cases that are coming up, but we will work with our customers to ensure that it's not just about announcing that we are electrifying, it has to provide the right solution to the customer. So this is not PV where you can just make a product and then launch it. This one we have to work with our customers and create the right solution for them. So we are working extensively with them. But yes, there are interests that have been shown by customers for these short range HCVs as well.
Balaji, it's been a pleasure talking to you today. Thank you very much for joining us on BQ Prime.
Thank you. Thanks for having me on the show. Thank you.
Thank you.
Bye-bye.